Hey, party people, welcome to this week's Money News in Human Words. And as always, there's a little bit going on at the moment. The first piece that I wanted to cover for this week was around inflation reaching its highest level since 1990 in Australia. Obviously, we're all feeling it at the petrol pump, at the supermarket, and it's something that's being talked about to the nth degree. But yeah, the numbers have come in and pretty staggering. Headline inflation up 1.8% for the September quarter, which brings the annual rate of price growth to 7.3%. These results were higher than expectations of the 1.6% quarterly growth. So came in at 1.8% compared to the 1.6% they were expecting. And they were expecting the annualized growth to be at 7% through the year. So that's the headline inflation number. There's also another measure of inflation, which is trimmed mean inflation, where they take out basically any large price movements. That also rose 1.8% for the quarter and 6.1% for the year, which suggests that inflation is really broad-based across the economy, even accounting for these smaller variables that have been changing more than most. So yeah, I suppose that the fact that things have come in above expectation has caused people to rethink what those expectations were, understandably. Essentially, what they're saying is that if prices continue to rise and rise above the forecast where inflation was expected to cap out, which is 8.75%, so not too far away from where we are now, saying that could then hit into the economy and potentially spark a recession. They're thinking that the impact of that could be potentially an extra 100,000 people joining the unemployment queue by June of 2024, and obviously increasing unemployment above the current 50-year low of 3.5% to somewhere around 5.25%. So a pretty considerable increase there. The government has forecast that the cash rate would cap out at 3.25% just in the most recent federal budget. But a lot of the banks don't agree with that, particularly in light of this recent inflation data that we're seeing. So the financial markets have priced in another increase in the RBA meeting on Melbourne Cup Day in November of 0.25%. But now they're ramping up expectations that the central bank could actually go higher than that in this meeting. My take is I don't think that they will, although you never really know, given that there's been such a considerable rise in the recent past. And they know, like we know, that it does take a while for these things to filter through into the economy. I think they will tread pretty carefully, although they could surprise things. They obviously do want to get inflation under control, but are still talking about this soft landing. And I think that's probably the key when the minutes come out from the meeting, how the RBA, what the commentary looks like around whether they're targeting this soft landing, what their tone is around that, I think will dictate what the policy looks like moving forward from here. But we have seen the banks come out saying that they think that the interest rates will go up above what the government has forecast. So NAB has come out saying that they think it will cap out at 3.6%. CBA has said, and ANZ have both come out saying that they think it'll cap out at 3.85%. Sorry, ANZ said 3.85%, CBA said 3.1%. So they're a little bit more favorable there. I suppose, obviously, with everything, time will tell. But yeah, so obviously the inflation data coming in higher than expected, not a good thing. What the RBA does, I think, is going to impact a lot of people. So no doubt a lot of nervous mortgage holders sitting on the sidelines waiting for their meeting to see how that goes. On a similar vein, CBA came out last week calling for change at the RBA. There's a lot of dissatisfaction out there around their handling of the recent economic challenges. Some of them, I think, with good reason. Some of them maybe a little unfair. Not that I'm defending the RBA as such, but looking at Australia, we are in a very similar position to basically everywhere around the world. And in fact, we're probably doing better than a lot of other countries out there. But the fact that the RBA, particularly that they've got involved in the bond market, which is unseen territory. A lot of people are up in arms. CBA have come out saying that they think that the RBA should hear more inputs to deliver a balanced view, and suggested a clear approach to, one, how the board is structured, and secondly, the information that the RBA is presented with. CBA have suggested a 3-3-3 board split between monetary policy experts, public servants, and private sector business leaders, as well as they've suggested that, which makes a lot of sense to me, that the RBA hear more from other people that want to petition them about information that they think would be relevant to the work that they're doing, which that's just seems like common sense to me. You think that given the gravity of the decisions that they're making, they'd want to get as many inputs from smart people as possible to make the best decisions that they can. And I think that one of the criticisms is that there's not a lot of change within the board at the RBA, and getting fresh perspectives is important. That being said, having someone that can follow through on a considered strategy over time is also important. You think about a business, if you're changing the CEO on a regular basis, then you get changes to strategies, and that doesn't make sense. So I think it is a tricky one. The entire world has been caught out with this current inflation crisis. The entire world reacted in a very similar way through COVID, with dropping interest rates to ultra low levels. And I think when I look at some of this commentary, I can't help but think it talks about the fact that there's always a lot of experts after the fact. It's something that I see a lot with our commentary that goes out in the media, and you get these people jumping on and saying, oh, everyone should have seen this coming, and it's so obvious, but it's not obvious. It's often not obvious in the moment. And these people, they're not facetiously trying to make the wrong decisions. They're trying to do what they can. Don't always get it right, but they're very difficult decisions with a lot of different moving parts and factors. So I think I think some of that criticism is a little bit unfair. But that being said, a lot of the suggestions being made by CBA make a lot of common sense. So we'll see how that one plays out with their next meeting. Shifting gears a little bit, talking investments, and wanted to chat about the current tech route. We're in the middle of company earnings season at the moment, and there's a lot of the big tech companies, the world's most valuable companies, showing signs of weakness, and their guidance is sort of showing that there is some trouble ahead with what's going on in the economy, recession fears, slowdowns, etc. Last week we saw earnings come out from Microsoft, Alphabet, the Google's parent company, Amazon, Meta, Facebook's parent company, and Instagram, showing that these runs that we've seen unfortunately can't just last forever. These companies are being forced to pull back on their spending, their hiring, their internal spending. We're seeing companies like Facebook come out saying that they're going to lay off 12,000 staff. Google is still hiring, but they're hiring at a much slower pace than they did before. And a lot of the companies are seeing the flow-on impacts of slowdown in the economy on streams like advertising revenue, and the profits are suffering as a result. Now, it shows that these massive companies, they're not immune to what's going on in the economy, that the shocks do impact them. And yeah, there's been a lot of commentary come out from analysts and industry experts that have been watching closely on this earnings data, saying that, overall the story is weak. It's not just in the numbers, but it's in what these companies are saying about what's coming up. Some stat that shows that there's only like between 20 and 30% of companies are even issuing guidance for where their profit would go from here, as opposed to 70% this same time last year. So companies are being cautious about what they're putting out there. They're also downgrading their forecast. Now, that being said, the 75%, I was looking at this stat, which is an interesting one, that 75% of companies have exceeded analyst forecasts in the most recent reporting cycle. However, noting that the analyst forecast tipped a lower rate of growth, which they forecast growth at an average growth across these companies of 2.3%, which is down from 4.5% at the beginning of the month. So that the forecasts are rounding down. The companies are beating those forecasts, but they're overall still much slower than what they were. Now, There's some tips for investors in there, I think, with these changes. I think if there is a recession and more of a slowdown, it's not just going to necessarily be one quarter. And the experts are saying that it could go on for some time. They say don't buy on the first downgrade. Although I feel like we've probably missed the boat there because the markets have been heading down for a while. But they're talking about the fact that it could go on for a little bit of time. That being said, you know, for a lot of years, it didn't actually matter which companies you bought. It just mattered that you were part of that rally. And this is something that we saw for people investing. It's also a big trend that we saw for people that own shares. We work with a lot of people in tech companies. They own shares in the companies that they work for. Didn't really matter which company you work for. All of these shares were running and people making a bunch of money as a result, which is great. But now with the market conditions and what we're seeing, if you want to be making money, you need to be more considered and strategic about, how much of your employer shares you hold and whether you hold any at all, to make sure that you don't just sort of squander that opportunity that's there. I think there's a lot of value there, but it is getting harder to find, and it is all about playing the long game. Following on from this, I was looking at a really a great piece of talking about how long it will take to recover the money that we've lost this year. Clearly, markets are well down from their highs. US market faring much worse than the Australian market. Australian market also down, but the US market is down much more considerably. But there has been a big rally over the last month. We saw the Dow Jones, the industrial index in the US, is up 14.4% and on track for its biggest month, on track for the month of October to be its biggest month since 1976, while the broader S&P 500 is up 8.8%. So it shows that investors are getting optimistic that the US Federal Reserve, the central bank over there, is nearing the end of that tightening cycle, and that the economic activity will start to recover and see a response from that. Inflation is still higher in the US, 8.2%, and the central bank is tipped to increase their interest rates from the current 3.75% to 4% in November, which goes from basically near zero at the start of the year. What happens is that this tight monetary policy has two main impacts on the economy. One is that it causes a slump in housing market, and it also leads to a stronger dollar, which then makes US goods less competitive on the global market. But that takes quite some time to filter through to the economic impact. It's not something that just happens overnight. People take a while to adjust their behavior. So generally it takes 1 to 2 years for those flow-on impacts to come through. And that's why we're seeing like the US economy is still growing. We saw third quarter growth 2.6% after declining in the first half of the year. But the data is saying that it's slowing. And yeah, that it's probably we're unlikely to return to the days of easy money with ultra low interest rates and central banks jumping into bond markets and that sort of stuff. And the experts are saying that it will take potentially a really long time for the recovery to come. But I suppose it really depends on how far the decline actually goes, because my take is that the governments and central banks have shown that they don't want to deal with the pain that comes when there is an economic downturn. And the last couple of significant downturns that we've seen, COVID and the GFC, have shown that the central banks and the governments now know that they've got these tools. They can muck around with monetary policy. They can use fiscal stimulus, tax cuts, government spending and those sorts of things, and new tactics that had never been seen before. So when there is a downturn, they want the economy to recover as quickly as possible. And so the recovery could be more swift and we could be back here sooner than a lot of people are expecting. Guys, that's it from me for this week. Fingers crossed for the RBA meeting. Fingers crossed for the Melbourne Cup. I will catch you on the next one. Bye for now.